States and around the world. The coronavirus outbreak is first and foremost a public health crisis, and the most important response is coming from those in the front lines, in hospitals, emergency services, and care facilities. On behalf of the Federal Reserve, let me express our sincere gratitude to those dedicated individuals who put themselves at risk day after day in service to others and to our nation. The forceful measures that we as a country are taking to control the spread of the virus have brought much of the economy to an abrupt halt. Many businesses have closed, people have been asked to stay home, and basic social interactions are greatly curtailed. People are putting their lives and livelihoods on hold at significant economic and personal cost. All of us are affected, but the burdens are falling most heavily on those least able to carry them. It is worth remembering that the measures we are taking to contain the virus represent an investment in our individual and collective health. As a society, we should do everything we can to provide relief to those who are suffering for the public good. While many standard economic statistics have yet to catch up with the reality we're experiencing, it's clear that the effects of on the economy are severe. Millions of workers are losing their jobs. Next week's jobs report is expected to show that the unemployment rate, which was at 50-year lows just 2 months ago, has surged into double digits. Household spending has plummeted as people stay home, and measures of consumer sentiment have fallen precipitously. Hotels, airlines, restaurants, department stores, and other retailers have been particularly hard hit. Manufacturing output fell sharply in March and is likely to drop even more rapidly this month, as many factories have temporarily closed. Overall, economic activity will likely drop at an unprecedented rate in the second quarter. Inflation is also being held down, reflecting weaker demand as well as significantly lower energy prices. Both the depth and the duration of the economic downturn are extraordinarily uncertain and will depend in large part on how quickly the virus is brought under control. The severity of the downturn will also depend on the policy actions taken at all levels of government to cushion the blow and to support the recovery when the public health crisis passes. The Federal Reserve's response is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We're also committed to using our full range of tools to support the economy in this challenging time. Last month, we quickly lowered our policy interest rate to near zero. We stated then and again today that we expect to maintain interest rates at this level until we're confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals. Of course, lowering interest rates cannot stop the sharp drop in economic activity caused by closures and other forms of social distancing. And low rates will not effectively spur the economy if those rates do not feed through to broader financial conditions or if households and businesses are unable to get credit. The economic disruptions caused by the virus created tremendous strains in some essential financial markets and have impaired the flow of credit in the economy. Without access to credit, families can be forced to cut back on necessities and could lose their homes. Businesses can be forced to downsize or close, resulting in further losses of jobs and incomes and worsening the downturn. Preserving the flow of credit is thus essential for mitigating the damage to the economy and setting the stage for the recovery. We have been taking broad and forceful actions to these ends. To support the flow of credit to households and businesses, foster smooth market functioning, and promote effective transmission of monetary policy to broader financial conditions, we have been purchasing large amounts of Treasury and agency mortgage-backed securities. The markets for these securities play a critical role in the economy, and they came under great stress last month as the scale of economic disruption became clearer and as investors clamored for liquidity. Our purchases have helped market conditions improve substantially in recent weeks. In light of this improvement, we have slowed our pace of purchases. We will continue our purchases of Treasury and agency mortgage-backed securities as needed. While the primary purpose of these securities purchases is to preserve smooth market functioning and effective policy transmission, the purchases will also foster more accommodative financial conditions. We are also undertaking programs to provide stability to the financial system and to more directly support the flow of credit in the economy for households, for businesses of all sizes, and for state and local governments. These programs benefit the economy by providing financing where it is not otherwise available. In addition, by serving as a backstop to key credit markets, the programs can improve market functioning by increasing the willingness of private lenders to extend credit. Many of these programs rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today. We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing and support from Congress and the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery. I would stress that these are lending powers and not spending powers. The Fed cannot grant money to particular beneficiaries. We can only make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers will benefit from our programs, as will the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend, and to make decisions about where we, as a society, should direct our collective resources. The CARES Act and other legislation provide direct help to people, businesses, and communities. This direct support can make a critical difference, not just in helping families and businesses in a time of need, but also in limiting long-lasting damage to our economy. At the Fed, we're doing all we can to help American families and businesses weather this difficult period. When the spread of the virus is under control, businesses will reopen and people will come back to work. We will continue to use our tools to assure that the recovery, when it comes, will be as robust as possible. Thank you, and I'll be glad to take your questions.
Tina Smialek.
Hi, Chair Powell. Thanks for taking our questions. You guys have cut rates to zero. You're buying up huge quantities of government debt. I guess the question is, what more can you realistically do to help the economy? Or where do you see a need for Congress to step in?
So let me say that we're committed to using our full range of tools to support the economy in this challenging time. We're going to use them, as I mentioned, forcefully, proactively, and aggressively until we're confident that we're solidly on the road to recovery. And also to assure that that recovery, when it comes, will be as robust as possible. As long as needed, we'll use them. And I would just say we have a number of dimensions on which we can still provide support to the economy. As you know, our credit policies are not subject to a specific dollar limit. They can be expanded as appropriate, and we can do new ones. So we can continue to be part of the answer. Will there be a need to do more, though? I think the answer to that will be yes. I would say Congress has also reacted quite aggressively and strongly with the CARES Act and other laws, several other laws, and that's appropriate. With enhanced unemployment insurance and the Paycheck Protection Program, we've seen an extraordinary, historically large reaction. But I would say that it may well be the case that the economy will need more support from all of us if the recovery is to be a robust one.
Nick Timrose.
Thanks, Chair Powell. Nick Timrose of the Wall Street Journal. I want to follow up on Gina's question and ask what specifically do you think elected officials should consider in order to help return or hasten a stronger return to full employment? And what policy tools did you discuss at your meeting today that might be used to stop a deflationary spiral?
So let me start. I'll take the questions in the order you gave them. So in terms of if I can say legislative priorities, we're not responsible for fiscal policy. Those will be decisions for Congress to make. But I would say that policies that protect workers, businesses, and households from avoidable insolvency, that keep businesses going so that they're able to produce goods and to either hold on to their employees or quickly rehire them, those are going to be key policies. They'll come with a hefty price tag, but we would come out of this event eventually with a stronger economy, with less long-run damage to the economy. So that's a key thing that really Congress could do over time. In terms of what we can do, I mentioned we have our credit facilities are wide open. We can do more on that front. In addition, we've had extensive discussions, as I've mentioned, done a lot of thinking about what monetary policy might look like in coming months over a range of potential scenarios for the economy. We do think that our policy stance today is right where it should be for now. As you know, we cut rates to the effective lower bound. And we've said that we'll keep them there until we're confident that the economy has weathered the effects of the outbreak and is on track to achieve our goals. With asset purchases, we're continuing to purchase Treasury securities and agency MBS in the amounts needed to support smooth market functioning. So we're doing those things, and I would say that we'll continue to use our tools as needs be.
Steve Leisman.
Mr. Chairman, question Steve Leachman with CNBC. I've got two questions here. First of all, why aren't you announcing or conducting a specific quantitative easing program? And maybe you could explain what the context is now of the purchases that will be made and the amounts that are to come. The second question I have is the Federal Reserve really taking enough risk to help households and businesses here, in that you just said that the programs that are out there may be best for those who are able to repay loans, but so don't you have a series of programs essentially lending only those able to repay, which is essentially helping those who may need it the least? Thank you.
So let me say again, in terms of asset purchases and other measures, we do think our policy stance is appropriate now. We've had discussions, as I've mentioned, over time and done quite a bit of thinking about what we might do in the future. We think for now our policy stance is appropriate. We're not going to change it now. And we're really waiting to see more from the economy. There are a range of potential paths the economy could be on. And I think as the time approaches then we'll address your first question, which is about asset purchases. So, but that's not something we're doing today. It's something that we have talked about, and for now we like our current policy stance. In terms of risk, we operate under the laws that Congress passes. And there are a number of aspects under Section 13.3, and you can see that they've permitted us to, I think, move very quickly and move into areas where we've never been before and do so quite aggressively. So I think we're going places and providing help in places where we never have, and I'm glad that we are. I think it's appropriate that we are. Nonetheless, these are lending powers, and if you read Section 13.3 of the Dodd-Frank Act, or the Federal Reserve Act, I know you have, it does require that we be secured to our satisfaction, and we can't lend to insolvent companies. It's clear these are lending powers, and we are ultimately bound to implement the laws that Congress gives us. We do not make grants, we can't make grants, and the reason I raised that in my remarks is that I just want to be clear on that. We can do what we can do, and we will do it to the absolute limit of those powers. We'll keep at it, and I just want people to know that we will be at it with the legal authorities that we have until we get through this thing. We will keep using our authorities, but there are authorities that we don't have, and there may be a need for those authorities to be used as well as ours.
Heather Long.
Hi, Chair Powell and Heather Long from the Washington Post. I have two questions for you, both on timing. The first, do you plan to launch the corporate credit facility and the Main Street lending facilities in May or early May? Anything you can give us a sense on timing? And the second, in the statement you refer today, the FOMC refers today to a lot of medium-term risks from the pandemic. That sounds like you all think this is going to be a long recovery, a long road to recovery. Can you give any more guidance on how you all see this recovery taking shape? Thanks.
Sure. So in terms of those facilities, the corporate credit facilities are near being finalized and will be operating, I would say, soon, fairly soon. Main Street facility is, we're close to announcing, to issuing a new term sheet. As you know, we put out a term sheet for comment a while back, and we got a couple thousand comments. We've carefully studied them. We've tried to reflect those in what we're doing now.